On February 1st, 2026, fewer than 1,800 homes were listed for rent across all of Ireland. That's the lowest February figure on record, and it's down 22% from the year before. In Dublin, the vacancy rate is sitting at around 1%. By almost any measure, that should be a landlord's dream market. But here's what's actually happening. Investors buying property in Dublin right now are getting some of the weakest returns they've seen in years. Gross yields in parts of the city have dropped to 3 to 4%. Numbers don't lie, and right now they're telling a story that doesn't match the headlines about a housing shortage. Let's break down what actually changed and why record low supply isn't translating into better returns for landlords. Before we go further, if you're into these breakdowns of what's actually happening in housing markets, not just the headlines, do me a favor and hit subscribe. I put these together every week, and it genuinely helps the channel when you do. Okay, back to Dublin.
Here's the core problem. Everyone assumes low inventory means landlords are winning. Less supply, more demand, higher rents, better returns. That's the textbook version. But in Dublin right now, prices have been rising faster than rents. And when the property you're buying costs more, but the rent you can charge doesn't keep pace, your yield gets squeezed, even if the market looks red hot from the outside. According to property analysts covering the Dublin market, the average resale property in the city reached roughly €613,000 by late 2025. Meanwhile, average rents for a two-bedroom apartment sit around €2,438 a month. On paper, that sounds like a strong return. In practice, once you factor in the actual purchase price, mortgage costs, and taxes, a lot of investors are landing closer to 3 to 5% net, not the 7 or 8% people assume they're getting. But that's just one part of the story.
Let's go through what actually happened over the last year. In 2025, Irish house prices climbed 7.4% year-over-year nationally, with Dublin prices up 5.6%. That's a healthy gain for anyone who already owns. But rents over the same period only grew 4.4% nationally, and the pace has been slowing. The CSO reported rental inflation cooling to 3.3% by January 2026, the lowest level since the pandemic. So prices are still climbing. Rents are still climbing too, but slower. That gap is exactly where yield compression comes from. At the same time, new national rent control measures took effect on March 1, 2026, replacing the old rent pressure zone system. The new rules cap annual increases at 2%, or the lower of that and CPI inflation for new tenancies. Economist Ronan Lyons at Trinity College Dublin, who authors the Daft.ie rental report, pointed to widespread uncertainty around those reforms as a factor behind landlords pulling listings before the changes kicked in. Sherry Fitzgerald, the country's largest estate agency, reported that private investors sold off roughly 42,300 rental properties nationwide between January 2020 and the end of last year. That's not new landlords leaving, that's existing investors deciding the numbers don't work anymore and cashing out. If that sounded bad, this next part shocked analysts even more.
Here's the full picture in figures. Dublin's average resale price around €613,000 against a national median of €381,000. Rental availability nationwide on February 1, 2026, under 1,800 homes, down 22% year-over-year. Dublin's vacancy rate, roughly 1%, well below the 5 to 7% considered a healthy, functioning rental market. House price growth in Dublin for 2025, 5.6%, rent growth nationally 4.4% and decelerating. Gross rental yields in Dublin, according to Global Property Guide's December 2025 data, averaged around 7.2%, but that's a broad national comparison figure. Once you drill into the premium Dublin submarkets like South Dublin City and South Dublin County, net yields after costs are landing closer to 3.8 to 4%. Cork, by comparison, is running hotter at over 8% gross. Landlord notices of termination rose 35% in the third quarter of 2025 compared to the same quarter a year before. Rental income tax for landlords remains steep, up to 40% income tax plus USC and PRSI, pushing the marginal rate for higher earners above 50%. Now, let's move to the real turning point.
So, why are prices still climbing if landlords are getting squeezed? Because two different buyer groups are competing for the same homes, and they're not doing the math the same way. Owner-occupiers are buying based on what they can afford to pay monthly, and with mortgage rates holding steady after the European Central Bank paused further cuts, that ceiling has room to stretch. Investors are supposed to be buying based on what the rent will cover. When owner-occupiers keep bidding prices up regardless of what the rent supports, investor yields get compressed almost automatically. Add in the tax exposure, the new rent controls, and the sense among small landlords that regulatory risk keeps climbing, and you get exactly what Sherry Fitzgerald's data shows: thousands of investors deciding to sell rather than hold. And here's the twist. When an investor sells a rental property, it usually gets bought by an owner-occupier, not another landlord. So every exit shrinks the rental pool further, even as overall housing supply stays roughly the same. That's how you get record-low rental inventory and falling investor yields happening in the exact same market at the exact same time. This shift has every investor in Dublin watching closely. Right now, completions are inching up. Ireland delivered somewhere between 30,000 and 34,500 new homes in 2025, depending on which source you check, still well short of the 45,000 to 50,000 units experts say the country actually needs every year. Analysts are watching closely to see whether the new national rent control rules, in effect since March, stabilize the market or push even more landlords toward the exit. Early signs are mixed. Some reports point to easing competition in Dublin specifically, even as availability outside the capital stays tight. For now, tenants are still facing some of the highest rents in Europe. Investors are getting some of the thinnest margins they've seen in over a decade, and the two problems are feeding each other. This is the part that surprises people. A housing shortage this severe was supposed to be a golden era for landlords. Instead, it's pushing a lot of them out the door. If yields keep shrinking while rents stay high for tenants, the incentive to stay in the rental business keeps getting weaker. And that's a warning sign every renter, investor, and first-time buyer in Dublin should be watching closely right now. The market flipped in a way almost no one predicted, and right now, homeowners, renters, and investors are all on edge waiting to see what happens next.